Welcome to Markets Now. I'm Michelle Rook with Alan Brugler with Brugler Marketing. And we did see higher livestock futures. We were steady to actually a little bit better in the soybeans. And Alan, let's talk about soybeans. They led the gains here today. Some of that was the bean oil rally, and some of it was obviously some of this Brazilian news this morning with lower production estimates, right?
Yeah, we've got CONOB lowering their estimate for soybean production again, and also corn production. The gap between them and USDA is getting a little wider here. Uh, you know, the thing is, there is a difference in methodology. CONOB's isn't quite as tight as far as surveys and some of the mathematical stuff that USDA does. But again, the indication is the crop is still shrinking. And that got reinforced a little bit today because you got some weather forecasts that are calling for 100-degree plus temperatures for a few days. That'll stress some of the South American crops. And the weather forecast, rainfall-wise, is looking a little drier. So that feeds into the concern about the second crop, corn in Brazil particularly, and maybe even taking the edge off of the big crop that we've got in Argentina.
So we mentioned bean oil rallying. Is that just following palm oil? Because, man, it has been a straight shot up here the last several sessions.
Yeah, the bean oil had become very cheap relative to palm oil. If you look at the spread charts between the two, CME Group puts those out. So a palm oil rally is going to tend to pull beans along with a little bit of a slingshot effect. And I think that's what you're seeing. You also had bean oil under quite a bit of pressure over the last couple of months. We got down to just a freck over 44 cents a pound on the nearby futures. That was needed because bean oil was losing a little bit of market share in the renewable diesel blending process. The percentage of the feedstock that was bean oil had dropped from 44% down to about 38. So, bean oil needed to buy some market share. But again, one of the competitors for that market share is palm oil and used cooking oil and those types of things. And if they're going up, bean oil can go up.
Technically, soybeans are above the 40-day moving average. So are the funds now covering their shorts, and can that push us above $12?
Well, they're definitely covering their shorts. I've got some price targets right at $12. I've got some others around 12.37-ish. Yeah, but what I need is a little more fundamental ammunition here, a little bit more, just a hint more export sales. We're not going to get big sales given the discounts out of South America this time of the year and the freight problems with the Panama Canal. But a bigger crush, likely to be record crush again when the NOPA and the USDA numbers come out next. So those are a positive, and the funds are short. So if the market's going up, they're going to bail and help to reinforce the rally.
Yeah, they've had a record short, so it'd be nice to see them cover some of that. What about this corn market? So we ended steady on Tuesday, but off session highs. Did we run up into chart resistance, or did you get some farmers selling when you got close to the 450 mark?
Well, I think we're getting a little more farmer selling. People are behind on sales. They need cash flow. They're buying inputs for spring here, or needing to make payments, So there's some money needs there, and that means you're going to sell into rallies. But it is kind of a virtuous cycle, because if the farmer selling picks up just a little bit, then you don't pressure the market. You actually create more liquidity, because the elevators are going to hedge those purchases. And then typically the funds can buy against those elevator shorts. So it can feed on itself and make the rally go further. I do like the setup right now from an export standpoint. Brazil's cut back to less than 2 million tons of exports for corn in March. They were down in that same vicinity in February and probably stay there through June. So there's 3 to 5 million tons a month of shipments that they had been making that are available for the U.S. to sell if we don't get too crazy on prices. So I want to see a rally. I want to see more corn exports. We should see third quarter exports over 800 million bushels if we're going to make the USDA numbers. I just want to see a nice orderly rally here.
Yeah, will that be enough? I mean, from a chart perspective, have we met the objectives that are going to get the funds to cover some of their massive short that they have in that market too, or not?
Well, we normally we expect a 38% or 38.2% Fibonacci number. That's a technical term, but that's it takes that much of a retracement rally just to get the winners out from the previous move, which of course was a big sell-off. So then you look around, there'll still be fun shorts at that point, but then you're going to sit there and say, okay, is there a fundamental story to get the rest of them out to go to the 50% or the 61.8 or something higher up? So the easy money is to go to 447 or so, but there's other objectives up into the 470s and 480s if we get this fundamental development to go with the short covering.
Yeah. And I know corn and wheat have been somewhat tied together, but the wheat market obviously has been trying to absorb these China cancellations that we've had recently. We did kind of score a key reversal in Chicago yesterday, but do you think that we're trying to turn the corner here? And what's now driving the market? Are we concerned about more cancellations from China, or what's going on?
I think there's still some concern that China hasn't canceled all of their bushels yet that they purchased from us. Some of them have been shipped, by the way. It's not just a complete wipeout. The math's pretty compelling, though. That the price drop from when they bought that wheat to where we are today makes it pencil for them to buy back those contracts and pay the penalties, and then go buy Russian or EU wheat to replace it, or possibly corn. So that's what's going on, and there is still some Chinese business on the books. So there's still concern about cancellation. The biggest problem, of course, is Ukraine and Russian wheat prices are way below the U.S. on the export market, and the EU is tracked down to almost their level. So they're kind of undercutting us too.
Yeah, and Matif wheat, when it goes down, we kind of follow that market, don't we?
Seems to happen a lot. It's for soft wheat at least.
No doubt. Okay, let's talk about the cotton market. We had a nice rally. We got old crop above the dollar mark. We got new crop close to 95 cents. What's driving that market, and will we go back up and retest those levels?
Well, I mean, it's pretty clear what's going on. The USDA keeps cutting the cotton yield from last year as the Jennings reports come out. As you take the cotton modules and process them into bales, you're finding out the yield wasn't quite as good as had been previously assumed. When you cut the yield, you're not changing the production at this point. We're past that, so you're just cutting production. Bottom line is with this March WASDE report last week, we were down to 2.5 million bales for projected ending stocks of cotton, and that is tight. So the market is very logically trying to buy more acreage here. And it's having to compete against corn in places like southern Kansas and in a few places trying to bid against beans. But it's definitely trying to buy acreage here, and it needs to have the rally that we've had to be competitive. The most recent calculation we did is it is competitive with 180 to 200 bushel corn. It's not competitive if you've got the ground that'll do 220 corn and say 1,200 pound cotton.
I think you and I have talked about at least 85 cents on December before it really becomes profitable and switches acres, or not?
Yeah, the 85 was kind of my target there. Obviously, that's just to get into decent money. It's not very lucrative like we had a couple of years ago. So it might take more than that to pull a lot of acres away. We've got weather considerations, soil moisture, and other things to look at too there.
You bet. Okay, so the cattle market did end back higher today, and we had sharply higher boxes at noon. We had a rally in the stock market. Was that what it was, or what pushed the market today?
Well, the fundamental story in cattle is still pretty bullish. We've got tighter feedlot numbers. We've got tighter feeder supplies. If we start pulling more heifers out of the feedlots, the things get even tighter. But that just makes the focus more on economics. Okay, if we know beef supplies are going to be tight down the road, the question becomes, will the consumer pay for it? And so when you get economic numbers that suggest the Fed's got to keep rates up, or or the consumer's getting squeezed in some fashion, it tends to be a negative for the beef, particularly because you can substitute pork and chicken. I would point out that we also had record beef imports back in January. We just recently got those census numbers. So we're supplementing the tight U.S. supply with more supplies from overseas too.
Yeah. So do you think that we're going to be able to negate last Friday's reversals on the charts in cattle?
Seasonal tendency for April cattle would be for it to work a little lower here into the 1st of April. April typically is a strong month versus February or June, but if you look at the more research and some of the other seasonal studies, April does tend to top out here in mid-March and then back off. So you're fighting history here. The ultimate judge and jury and umpire on this is what's cash cattle doing, and so far that market's holding up fairly well.
Yeah, definitely. That has been one of the strong suits of that market. You mentioned the economy, and obviously we saw the CPI data come out this morning, maybe a little hotter on inflation than expected, yet the stock market was able to still rally. What did you make of that?
Yeah, it's always encouraging when you get what's hypothetically bad news and the market moves higher, right? The sell the rumor, buy the fact sort of thing. Uh, yeah, the higher than expected CPI, the core CPI 3.8%, month to month up 0.4%. Basically, that says the Fed can't lower rates or probably shouldn't lower rates. I think market thinking has shifted away from March towards June now as the most likely time they would start to raise rates. I didn't see anything in here today that said they should be more aggressive about that. So I think the stock market just said, well, we prefer lower rates, but on the other hand, we've got some pretty good earnings numbers, and from some of these companies, you saw a rebound in Nvidia after a nasty little sell off. So that's going to skew some of these stock indexes too.
Yeah, no doubt. But definitely, we are kind of watching this from the commodity perspective because if money's going over to the stock market, does that mean it's not going to be in the commodities or?
Yeah, it tends to mean that you're fighting for the hot money, right? There's a certain, I mean, there's hedgers and there's traders that commodities are their thing, but there's a hot money pool that goes wherever it thinks there's a return. So as long as the stock market's going up, it's more comfortable being in stocks, and as long as inflation's kind of under control, it sees no particular reason to go to commodities. Commodities do tend to outperform stocks in a high inflation environment. But 3.8% isn't a high inflation environment. It's just maybe not slowing down as rapidly as some folks had hoped that it would.
Yeah. All part of the puzzle, though, of what we trade every day. All right. Thanks for joining us, Alan Brugler with Brugler Marketing. That is Markets Now.